Your paycheck lands. A small notification, the kind you have been checking since 8 in the morning. $104,000 a year, finally, after the promotion. Tyler leans over your shoulder in the break room, grinning, already spending it out loud before the coffee finishes brewing. You do not smile back. You are doing the math, because that number on the offer letter is not the number you are about to live on. Something is going to take a third of it before you ever see it, and then several more things are already lined up to take most of what is left, quietly, this year, unless you know exactly where to look. Stay for this one, because by the time we get to the last number, you are going to open your own banking app tonight and start running the exact same math, whether you feel ready to or not. Marcus does not say any of this to Tyler. He just watches him celebrate a number that was never going to be real, and starts running what he privately calls the accounting. Here is the part almost nobody adjusts for. The salary printed on your offer letter is not a budget, it is a headline. Between the day it is announced and the day it actually reaches a checking account, a long line of collectors gets to it first, and every one of them takes their share before rent, before groceries, before a single dollar of that number touches your life. Federal withholding takes a slice, payroll tax takes another, a state, depending on where you live, takes a third. Health insurance, which functions less like a benefit and more like a membership fee for staying employable, takes a fourth. By the time all of it clears, a person earning $100,000 a year is often living on something closer to $65,000 or $70,000. Nobody tells you that at the offer stage. The number in the interview is the number designed to make you say yes. The number in the bank account is the number you actually have to survive on. Call this gap the shadow deduction. Not because it is hidden from the government or from your employer. They all disclose it somewhere on a pay stub nobody reads closely. It is hidden from your own spending because your brain anchors to the bigger number the moment you hear it, and your lifestyle quietly grows to match a figure you were never going to take home. You sign a lease sized for $100,000. You finance a car sized for $100,000. You live, every single month, against a number that has already been reduced by a third before you ever saw it. And the difference between what you think you earn and what you actually keep is exactly where most six-figure households start bleeding. If you want a fast version of the accounting, take your gross salary and subtract a third. That smaller number is your actual starting line, not the one on the offer letter. Sit with how much smaller it feels. That feeling is the whole video. The shadow deduction is only the entry point. It is the first drain, the one you cannot avoid, since it happens before the money is even yours to manage. The next several are optional, and that is exactly why they are more dangerous. Nobody forces you into them. You walk in willingly, usually while telling yourself you have earned it. Start with transportation, since it is the fastest way to turn a raise into a decade of debt. The average new vehicle payment today runs high enough that most buyers never calculate what the loan actually costs them, because the dealership is not selling you a price, it is selling you a monthly number small enough to approve without flinching. Stretch that loan to 7 years, and the total interest paid on a $50,000 vehicle can run into the tens of thousands beyond the sticker price. Now flip the math. Take that same monthly payment and put it into an index fund instead for the same 7 years, and you are often looking at a number close to double what you would have paid in interest. Let that grow untouched for another 20 years, and the car did not just cost you a vehicle, it cost you a retirement. The boring, rich version of this decision has a simple shape, a meaningful down payment, a short loan term, and a hard ceiling on total transportation cost, insurance and fuel included, relative to what actually lands in the account after the shadow deduction. Anything past that ceiling is not transportation anymore. It is a subscription to looking successful, paid monthly, for years, to a lender who will never once ask if it was worth it. If any of this is landing, a like costs you nothing and tells this channel to put it in front of more people who are quietly doing the same math right now. Housing runs the same trick at a larger scale. Renting gets called money down the drain, as if paying a landlord is the mistake and paying a bank is somehow different. It usually is not. not for the first decade. On a typical mortgage, at current rates, the interest alone in year one can exceed what the same person would have paid in rent for a comparable place, before a single dollar goes toward the balance. Add property tax, add maintenance, add the slow mechanical decay every house quietly runs on, a roof, a furnace, a water heater, all of them aging whether you notice or not, and homeownership stops looking like an investment and starts looking like a very expensive form of stability. That stability can absolutely be worth it. The trap is buying it as a status purchase instead of a utility purchase, and stretching the loan term further and further to make an unaffordable number look affordable on paper, which does not fix the problem. It just hands a larger version of it to whoever inherits the mortgage after you. Then there is the convenience leak, the smallest individual charges and the largest total damage of anything on this list. A meal that costs $12 at the restaurant becomes $22 through a delivery app. Once the markup, the delivery fee, the service fee, and the tip are stacked on top of each other. Order that twice a week and you are not spending $1,500 a year on convenience. You are spending the version of that number that compounds, since the same amount invested instead grows into several times itself over a decade. This one has a name too. Call it the comfort leak, because it never feels like spending. It feels like exhaustion relief. And exhaustion relief is a much harder habit to give up than a luxury purchase, because you can talk yourself into needing it every single day. Subscriptions run the same leak on a slower drip. Streaming, storage, software, a monthly charge for nearly everything you use to simply own. Individually, each one looks harmless. Stacked together, a household can be quietly bleeding well over $100 a month across accounts nobody has audited in over a year, which adds up to more than a couple $1,000s annually spent on permission to exist inside a handful of apps. The boring rich rule here is almost insultingly simple. One in, one out. A new subscription does not get added. It gets swapped for one you already have and barely use. If you are not subscribed yet, now is a good time. New episodes come out every week, and this channel exists specifically for people running these numbers on their own life for the first time. Now, the trap that actually catches the six-figure earner, specifically, the one making $150,000 a year, who is still one bad month away from real trouble. Call it what it is, a high-income household with almost nothing behind it. The mechanism is lifestyle anchoring. Every raise quietly resets the minimum acceptable version of a car, a vacation, a bottle of wine at dinner, until expenses are tethered directly to income instead of to actual need. A $20,000 raise gets absorbed by $21,000 of new lifestyle, because the raise felt like permission instead of an opportunity. The real measure of wealth was never the title on a resume or the car in the driveway. It is how many days a household could survive if the income stopped tomorrow. Most six-figure households, if they are honest, do not like that number. There is one leak on this list that is not really a leak at all. It is money walking out the door that already belonged to you. Most people treat an employer retirement match like paperwork from the first week of a new job, something you signed without reading and never thought about again. Treat it instead like the single best return available anywhere. If an employer offers to match a percentage of what you put into a retirement account and you contribute less than that percentage, you are handing back free money, guaranteed, on day one, at a return no stock pick, no side hustle, and no crypto chart has ever reliably matched. A household earning six figures who is not capturing the full match is not simply missing a benefit. They are quietly funding someone else's balance sheet with money that was already theirs. There is a second version of status spending that deserves its own line, since it hides in plain sight on almost every closet rail in the country. A plain shirt costs a fraction of the price of the same shirt with a logo stitched onto it, and the difference is rarely about material or craftsmanship. It is a fee for turning yourself into free advertising for someone else's brand. Run a real cost per wear on a closet sometime. A piece worn twice a year at several $100s is not a purchase. It is a very expensive costume rented out to an audience that forgot about it by the following morning. None of this works, though, without one buffer sitting underneath it, and it is the one number that changes how every other decision on this list actually feels. A household with nothing in reserve is not just financially exposed, it is mentally exposed. Every decision gets made from panic instead of patience, because a single flat tire or a single vet bill becomes a 5-alarm emergency instead of an inconvenience. A modest cushion, even a few $1,000s set firmly aside and left alone, is not really savings. It is the difference between negotiating from strength and negotiating from fear. Once that buffer exists, a person stops being reactive by default and starts being the one running the numbers instead of the one being run by them. Here is where the two directions actually split. Picture two people, same age, low 30s, same income, same starting point. One of them, we will call him Tyler for the sake of the story, leases a new truck every 3 years because a lease payment always looks smaller than a loan payment, and because driving something impressive matters to him more than he would ever admit out loud. The other, we will call her Rachel, buys a reliable used vehicle outright, keeps it 8 years, and puts the difference between what Tyler pays and what she pays into an index fund every single month without exception. Over 30 years, that gap alone, invested and left untouched, grows into a sum well past $1 million. Tyler is not reckless. He has a good job, a good credit score, and a driveway that looks like success. Rachel just never let her driveway do the talking, and 30 years later, the only difference anyone can actually measure is the one that was never visible from the street. None of this is really about cars, or vacations, or a bottle of wine. It is older than any of that. A century ago, an economist named Thorstein Veblen described the exact behavior we are talking about. Spending not for the use of a thing, but for what it signals to people who are, mostly, strangers. The uncomfortable part is how well that idea still holds up. Most status spending was never really a purchase. It was a payment made to an audience that was barely paying attention in the first place. Which is exactly why the quiet version of this works. The people who are actually ahead are rarely the ones announcing it. They are driving something unremarkable, while their brokerage account quietly does something remarkable in the background. There is a real advantage to that beyond the math, too. Nobody negotiates hard against someone who does not need the deal. Nobody manipulates someone who is not performing an image they are afraid to lose. The less your spending advertises your income, the more leverage you actually carry into every decision that follows. If you want us to run this same accounting on a situation closer to your own numbers, drop it in the comments. That is usually where the next one comes from. So here is the boring exit. 3 moves, none of them requiring willpower, because willpower runs out by 3 in the afternoon, and a system does not. First, automate the transfer. A fixed percentage of every paycheck moves into a separate account before it ever reaches a checking account you can see. Money you never touch is money you never miss. Second, run a weekly sweep. Once a week, anything sitting above a small baseline in checking gets moved into savings or investments. No debate, no exception, just movement. Third, keep it simple on the investing side. A low-cost, broad market index fund, held for decades, beats most attempts to outsmart it, and it asks nothing of you except patience. None of these 3 steps are exciting. That is the entire point. Excitement is expensive. Boring is what compounds. The categories in this video are not evil on their own. A car is not evil. A vacation is not evil. A subscription is not evil. Right now, for most 6-figure households, those tools are simply being used against them instead of for them. One shadow deduction and one comfort leak at a time. Back in the break room, Tyler is still talking about the raise, planning the truck he is about to lease to celebrate it. Marcus finishes the accounting in his head, says nothing about it, and orders the same coffee he always orders. He is not impressed by the number Tyler is celebrating, and he is not worried about it either. He already ran his own numbers, weeks ago, quietly, and he already knows exactly where every dollar of his raise is going before it ever lands. That is the actual difference between the two of them, and it was never going to show up in the parking lot. If any of this helped you see your own paycheck differently, share it with someone who just got a raise and thinks the hard part is over. It usually is not. It is just getting started.